In this video, traders, we are going to look at, I keep chasing stocks that have moved too high already and getting caught in an inevitable pullback that hurts me, probably stops me out. What do I do? Stay tuned. Hey traders, a very warm welcome to you. All right, so let me just have a look and see who this question was from. Gwent Champ, appreciate your question, Gwent, I really do. This looks like this came in quite a while ago actually, so apologies if I just got to it now. Maybe you've not watched anymore. But anyway, I tend to chase stocks that have already climbed too high and the resulting inevitable pullback stops me out, resulting in a slight loss. And by slight loss, I mean that it doesn't matter if it's a loss or not. If you're getting stopped out, it's frustrating, right? If you're doing it time after time after time, it's annoying. So Gwent's basically saying this. And guys, we can probably all relate to that. Give it a thumbs up and a comment if you can relate to this. I know that I can. Fortunately, you've got some tactics we're going to share with you now to deal with this. But it's all, you know, everyone does this from time to time. You know, the stock's doing this. You think, oh, you know what, it's going to rip. You've got a target up here, or you can see is in your mind how high it's going to go. You're super excited about it. You don't want to miss out on it. The old demon of FOMO comes in, and I've done a few videos talking about that specifically, but that's sitting there. And you go, right, I'm gonna have to buy this thing because it just keeps going higher and higher and higher. And that was a thing, a lot of people did that with the cannabis stocks that were ripping up not so long ago, cryptocurrencies not so long ago. And, you know, sometimes, of course, if you look at things like some of the bigger technology companies like Netflix, Amazon, etc., they start to rip and they stay high. Yes, there's pullbacks and stuff, but they do stay high. But often, as I kind of mentioned before, you sometimes sit through brutal pullbacks. Even Amazon, I think, pulled back 90% before it ripped up to highs. Plenty of 50% pullbacks. Anyway, the point is, you end up buying here, thinking it's going to go higher. It starts to pull back on you. And it stops you out because you just can't take the heat anymore. You're in too much and you don't want to give it that much room, and you end up getting stopped out and it ends up being super frustrating. But the dilemma you're in is that, okay, or the kind of the internal dialogue that you get, and if we get a different color pen, here we go, the purple, the internal dialogue you have in your mind, should I say, when it's here, is that you believe it's going to go to here, for example. Yeah, you think that's going to happen. And you've kind of been watching it perhaps since about here, or maybe even about here, and you haven't got on board it, but now it's going higher and higher. It feels like you should be on it. It feels like you missed it so far and you don't want to miss it anymore. I'm not prepared to miss it anymore. I've already missed so far, I don't want to miss it anymore. And so you end up buying here, and generally speaking, you're not thinking about, okay, how far could it pull back? What's going to happen to this? And then, as we say, it comes back down, stops you out. And more than likely, just to rub salt into the wound, it then carries on and drifts up and tags the target, and it's super frustrating. So how do you solve it? Well, first of all, there's a couple of things you can do. The first thing you can do is in fact, there's multiple things you can do, but let's just talk about two in this video. The first thing you can do is to add a very small position. I find this works quite well, especially if that FOMO demon's drilling away there. Very small position. I've talked about this in kind of more depth before, but I'll just summarize it now. Very small position that really gives you a lot of room. So you can kind of monitor it. And actually, a good thing about doing the small position is the earlier you add the small position, the more likely you are to be watching the market a little bit more intently. So if you had monitored it here but hadn't pulled the trigger, the small position strategy means that you may put a tenth of your position on. So you're already in a little bit. You're already feeling quite good that you haven't missed it. So now you're trying to time it for a larger position. And now you time it for a larger position that's got a good risk-reward ratio. The other thing you do, in fact, there's two things. Let's do A and B here. Let's do 2A and 2B. The other thing you can do in a kind of different approach is you can go back and you can look at your results and say, well, okay, what is the common theme here? Because if the common theme is that the market is pulling back excessive, okay, the common theme might be as simple as if I had just put my entry where my stop was, this would be a monumental successful strategy. Now, does that solve things long term? No, but it guides you into developing a new strategy that you know is working in your favor and is serving your trading results. Because, for example, if you are getting stopped out all the time here and you've gone back in your last 10 trades and 8 out of 10 of them you're getting stopped out there, you know if you had put your limit there, and let's assume that you're getting that, maybe some of them are carrying on lower. If you assume that, okay, if I just bracketed my whole trade down, so instead of my entry being here, my stop here, I just went clunk, and that was a profitable strategy, then why not do that moving forward? Yes, it's hard to quantify sometimes, because especially if you're just pulling the trigger based on feeling alone, it's hard to quantify that. But then at least when you get that feeling and say, well, where should my stop have been? Right, my stop would be here. Let me put it in there and leave it. But the moral of that story, if you like, or the kind of data you're getting, is that you should always put a limit under the market. Always, always, always. If that data is showing you that you're chasing constantly, you're getting stopped out, the solution is at some level, I don't know what that level is for you or whatever circumstances you're in. This is the kind of the broad question from Gwent, but it applies to everybody. Is at some point you need to just put a limit under the market. Now, is that $5 if it's a stock? Is it 5%? Is it a stock? Is it 100 pips if it's a currency? But data is telling you you're chasing, so the easy way to do it is to at least start by bidding under the market. And yes, you're going to miss some, so maybe using conjunction with that small entry strategy or piece of the trade size strategy, or you just say, listen, I know that this is best and effective for me because I've proven it, I've seen it, I know that if I did that in my last 10 trades I will be up X amount, so I need to believe that that's in my best interest to do it moving forward. So that's one thing to do, guys, is look at your strategy and then just literally plug stuff down. Or even if you don't want to go back and look at all your stuff, if you know that this is a problem for you, then just say, when I'm about to go in, just say, okay, I'm going to put a limit under. You can even, if the FOMO is so bad and you're like, I don't want to miss out and it's so frustrating you, put 1/10 of the position on that chase point and put the 9/10 of the position on a really aggressive, or not too aggressive, but a quite lenient bid, if you like, under the market, otherwise a reasonable way away. So if it does fly off, you've got something in it. If it doesn't, comes back, which is most likely to do based on your historical trading performance, you're going to get filled on the full size at a better price and the whole thing's going to rally up. The final thing I want to say to you guys is this is something that bigger traders will do very, very often, is they won't try and pinpoint one entry. They will stagger their entry across a period of time. So for example, if you're swing trading with, let's say, a 6-month outlook, they might spend 2 weeks adding a little bit of the position at the open, if you like, or the close, or the VWAP if you can get it. A bit harder to do that as a retail trader over the 2-week period. And then just say, well, my ultimate goal is this, I'm going to scale in. And yes, in your mind you're thinking, well, I should go in now because I believe it's going to go up. But if you're getting results that are counterintuitive to what you believe, or contradictory, should I say, to what you believe, then staggering the position, whether it is over a few weeks, whether it is over a few days, whatever time frame it is, means that you're kind of neutralizing that chase effect a bit. And if you're strict with it, you'll listen, I can't do anything but execute. I decide I'm going to execute X thousand shares over X number of days in these tranches. So your job now, you've made the decision as the hedge fund manager, if you like. Now as the trader, the execution trader, your job is simple. You're not trying to time things, you're not trying to do anything. The manager, you over there, wants to be long. You as the execution trader now just needs to execute those tranches of stock during that period. Now whether it doesn't matter if you're trading 100 shares or they're trading 100,000 shares, you can still do exactly the same thing and execute it. That will dampen down that. If it does rip off, then you'll be obviously at higher level. If it does kind of consolidate and wind back, then you'll be at more of an even level. A good way of neutralizing that thing. And also, when you get the urge to do it, of course, okay, get the urge. Well, my first batch is a 10th. Right, I know I'm doing another batch in a few hours. It might make you think, I don't want to chase this. I don't like it. I don't think it's that good. And then you can ultimately say, well, you know what? I don't want to take it anyway. And only 1/10 of the order is not going to hurt you too badly. Final thing is, I keep thinking of a final thing, but these things keep coming to my mind. I want to add this to you guys, give you much value as possible in this video. The point is then, if you're staggering your entry and where's your stop going to be, of course, you need a kind of penultimate stop. So you need to kind of have some framework around that. There's no point just adding, it suddenly falls to the floor and you're saying, well, I'm sticking to adding every single day. Well, no, of course, if there's some point where it's obviously the hypothesis of the trade is incorrect, then stop that and you won't lose as much because you've been adding, and then you cut it. So at least have some mind where you don't want to carry in the trade, so protect you against catastrophic loss, just adding all the way down when obviously the hypothesis of the trade is incorrect. That's the final thing for you guys. I appreciate the question and hopefully it's helped others out there as well. I know that it's a very common thing, this is, and if you've got any strategies or ideas and methods to counteract this, then stick it in the comment section below. Always interested to hear your guys' thoughts. I appreciate the questions, support, subscriptions, likes, comments, shares, and all of that. Much appreciated. Take care, guys. Bye-bye.